Hello and welcome back to Let's Talk Real Estate. My name is Kristen Jock with Compass, and on this week's episode I'm discussing the components to an offer. And this information will be useful to both buyers and sellers in making an offer as well as receiving an offer to purchase a home. So the first major component is pretty straightforward. That's the purchase price. So you have the asking price of the property, but then you have the price that you're planning to offer when purchasing the property. Second component would be the terms. So is the offer a cash offer or is it a financing offer? And if it's a financing offer, what is the percentage of the property being financed? So is it 80%? Is it 90% or is it 50%? That should be indicated. Then you would have an indication for what is the down payment. So if you're financing 80%, your down payment would be 20%. If you're purchasing all cash, then it would be 100%. And then generally there are some documents that should be provided. So if it is an all cash purchase, typically a seller would want to see proof of funds, and that could be in the form of a letter from their CPA or a letter from their bank or even a bank statement. If a buyer is planning on financing, a seller may want to see their pre-approval letter. The next component would be contingencies. So you have a couple of contingencies that are pretty common. First would be an engineering report. Another one could be a need to sell. So you may have a purchaser who is making an offer, but before they can close on the purchase, they would need to sell an existing property first. And finally, a gift. So a purchaser might be purchasing a home with a gift from a family member. And in that case, they should be showing a gift letter. And that would be something that's signed off from the person who's providing the gift for the purchase. And this is indicating that they're willing to give those monies. Another component would be whether the purchaser is pre-qualified or pre-approved. And this would be the case if the purchaser was planning to finance their purchase. So pre-qualification is generally when a purchaser is asked certain qualifying questions. So that would be their income, their assets, their debts, what they think their credit score is, things like that, to pre-qualify them for a number that they would be qualified to purchase with. A pre-approval, on the other hand, would be when those questions are asked in the form of an application, but then documents are collected, credit is run to then verify all of the answers to those questions. The next component would be timeline. So in other words, what is the estimated closing date? And that traditionally is somewhere between 30 and 90 days. When you have a cash purchaser, they might be willing to close within 30 days. For a purchaser looking to finance, traditionally it might be somewhere between 45 and 60 days. And then if you have maybe a purchaser who is buying but needs to sell their property first, maybe they're looking for 90 or more days. And the final component would be concessions. And you can have both buyer and seller concessions. An example of a buyer concession might be the flip tax in a co-op or the transfer taxes in a new development condo. And an example of a seller concession would be the financing costs for a buyer. And finally, I just want to leave you with some tips in helping to make an offer, receive an offer, and hopefully have an accepted offer. So the first one is to be responsive. I often tell my clients, whether they're on the buying or the selling side, that time kills all deals. So the longer it takes, the less likely that offer is to be accepted and actually get to contract and closing. The next is a little bit about fact finding. So trying to find out what are the buyer or the seller's motivations. It could be things like, why is the buyer buying, or why is the seller selling? Are they relocating? Do they have an expanding family? What are some things that can help to give you a little bit of an edge in negotiation? Next would be days on market. So evaluating how long a property's been on market can help you to figure out and evaluate how much you can potentially negotiate on that property. So if the property's only been on the market for, say, 7 days, a seller might be less willing to negotiate at that point. However, if in your fact finding you discover that the seller is relocating for a job and has a very short window of time to complete their sale, you might then realize that you have a better chance at negotiating because they have a short period of time to sell. And if the property's been on the market for a long period of time, say 6 or more months, that's usually a good indication that you have something that's impeding the sale, and you may be able to negotiate more than you would if the property were newly on the market. So the next tip would be looking at comparables for similar sold properties in the area, as well as looking at the condition of the property and any renovations that might be planned and what that cost for that renovation would be in order to determine a valid and reasonable purchase price for you to offer. The next tip would be looking at competition. So are there any existing offers? And this might be as simple as asking the listing agent or if there's any existing offers, but you might be able to deduce this in other ways. So if you go into an open house and it's pretty crowded and people seem excited and you hear them asking how to make an offer, you might be able to infer from this observation that it may be a competitive scenario, and your offer, if you make one, might be up against other offers. Another way that you might figure out that there's competition would be if you receive an email after a showing asking for best and final offers to be submitted by a specific deadline. So this would also help you to infer that there's a competitive scenario going on and other offers that will be competing along with yours. And finally, I want to talk about successful negotiation. And successful negotiation to me is when both sides walk away feeling that they got something that mattered to them. And there are scenarios where what matters to the buyer might be the same thing that matters to a seller. So you have to find some sort of compromise on the specific item. And I'll give you an example. So you may have a buyer whose timeline is really important to them and a seller whose timeline is really important to them. Perhaps the buyer has a rate that they want to lock in for 45 days, and so it's really important that they close within that 45-day period. On the other side, you may have a seller who, now that they've accepted an offer on their property, needs to go and find a new home to live in, and so they're also concerned about the timeline, and on the contrary, they're concerned about having to move too quickly. So a way that you could compromise in this scenario might be to agree to close within the 45-day window, but allow the seller to stay in the property post-closing. And usually what happens in that scenario is the seller would pay the carrying costs of the buyer as a form of rent while they're living there, but that gives them extra time to then go and find the home that they're going to move into. So both sides win in the timeline scenario. I hope that this information is useful both to buyers and sellers, making offers, receiving offers, negotiating offers. If you have questions or comments, please leave them below. If you've experienced an offer that had one of the components that I didn't mention, so maybe it's a non-traditional transaction, please share your story below and I'll be happy to comment on it. I hope that you all have a great day, and I look forward to seeing you next week. Take care.